That's not important, but the risk in a portfolio, when stocks are in the portfolio, that is, we measure the risk using the covariance and the co-moment. If stocks are in efficient portfolio, so you can measure that expected return or the rate of return of that particular portfolio using capital market line. So slope of the capital market line you can estimate using that expected return market minus risk free divided by market risk. So I show you this formula and you can apply this one. But the problem with the capital market line, it's include only the efficient portfolio, but most of the investors are all the inefficient portfolio. So in case of the inefficient portfolio, so you might questioning how to measure the risk or how to measure the required rate of return. So now there is an empirical model developed for that, that is CAPM. So based on the CAPM and the security market line, the graphical presentation of the this CAPM model is the security market line. So using the security market line, you can estimate required rate of return or the price risk related to the that particular level of risk. Right, so here we are using beta. Right, so beta is a measure that is market risk, or it measures the market risk. So beta we measure related to the portfolio, related to market portfolio. So therefore you can remember beta you can measure for variance. Now if you want to measure the beta of Sampath Bank, say, so you can measure covariance of the Sampath Bank return with the market portfolio divided by variance of the market. So using this, you can measure. So beta, we interpret related to the market portfolio. So empirical version of the CAPM looks like this. So empirically, using stock returns and the market return, you can estimate beta. So when you regress the stock returns on market return, so that slope of the line, slope of the regression is the beta. So empirically you can measure. So beta interpretation and the things we discuss. So I think we discuss up to that point. So that's very interesting story. Or even though we measure the risk using standard deviation or the variance, now you might realize that relevant risk is the market risk. So market risk, beta risk, we can measure using the beta factor. So that using that capital asset pricing model. So CAPM argued that when all the investors are all the market portfolio, so the risk of a particular stock is that stock's contribution to the market portfolio risk. On that way, you measured that. So those are the things that we discuss up to now. So now this is our example. This is our previous example. So you construct a portfolio even using these two stocks A and C. I told you to do as a homework. So now you can calculate beta factor for these stocks. Stock A, stock B, and stock C. So I think you clear how to measure the beta. So beta, you can calculate covariance of the stock returns with the market portfolio divided by the variance of the market. So we can use this formula to measure the beta of these stocks. So using the Excel sheet, actually I have measured these things. So I think that time is not enough to calculate all the betas for this stock. But once this is our example, right? This is our example. I think you can see the Excel sheet. So you can estimate expected return A, B, C, D, and market portfolio. And also you can estimate variance. I think you can see the formula. And the square root of that is the variance. So now here, covariance, stock. This is stock A, right? This is covariance stock B. This is covariance stock C, right? So then you can calculate beta for the A, B, and C. A, covariance divided by the variance of the market. So here variance of the market is this one, right? Variance of the market. This is market portfolio. No? So then beta will be these numbers. So later you can calculate them, right? I'm not going to use the time because that time is very limited. So beta for the stock A, B, and C, 1.3. So you can see stock A is more risky than the market even. Now here you can see stock B is the negative beta. You can see the relationship beta is moving opposite to the market portfolio. I think in the last day I told you that security B and market portfolio move into the opposite. So you can see that beta. මතකද මං කිව්වේ දැන් A සහ market portfolio එක they are moving to the same direction නේ. market එක comfortable වෙනකොට market එක හොඳ වෙනකොට returns උත් වැඩි වෙනවා. But when you look at the stock B, so you can see they are negatively related. So even beta is minus, negative beta. For the C, 0.89. So that is less than 1. So likewise, I request you to calculate beta in later in your homework. So you can see the betas for this stock. Right? So now, once you calculated beta, so using these formulas, you can calculate beta. So those are the beta for the stocks. A 1.29, B minus 8.86, C 0.89. For the market, remember always beta is equal to 1. For the market portfolio, beta always equal to 1. So beta for the treasury bills or the government securities is always 0. So now, based on this beta and using this security market line, so now you can estimate required rate of return. So this is the required rate of return that should be in line with the beta risk, in line with the market risk. Now earlier, I think you remember that for this security A, B, C, and also for the market, expected returns we have calculated. See, those are we calculated using this probabilities distribution, expected returns we have calculated. Now, we are going to estimate required rate of return using these beta factors. So this is our formula. This is our CAPM formula. So using this, you can estimate required rate of return for A, B, C, and risk-free rate is same, no? For the securities A, B, C, because they are not efficient, no? So now you can't apply capital market line. So we don't know whether they are efficient or whether they are on efficient portfolio or not. But anyway, either portfolio efficient or not, you can apply CAPM because it measures the securities risk related to the well-diversified portfolio. So in well-diversified portfolio, no unsystematic risk. So it measures that particular stock's contribution to the market or that portfolio risk. So that way, I think no need to repeat again. So now risk-free rate is 8%. Market return is 15%. So here, this is market return. 15%. And we have calculated beta for each security. And also market risk premium in the CAPM model. Actually, I forget to tell that in the CAPM or this CAPM model, this market return minus risk-free rate, this one, market return minus risk-free rate, we call as market risk premium. Market risk premium. That is the price of beta risk in the market. එක beta risk එකකයක් වෙනුවෙන් market එකේ දෙන premium එක. අන්න ඒ වගේ එකක්. Market risk premium. So that is the difference between market return minus risk-free rate. So market risk premium you can calculate if you know the market return and risk-free rate. So here market risk premium is 7%. Beta risk එකකයක් වෙනුවෙන් market එකේ කරන ගෙවීම. එතකොට ඒක 7% නම් අපේ ස්ටොක් එකේ බීටා එකෙන් වැඩි කරපුවාම අපිට එනවා අපේ ස්ටොක් එකට අදාළව risk premium එක. In the marketplace, this is the price of the systematic risk, 7%. So then this 7% you multiply by the relevant beta factor of the stock, relevant beta factor of that particular stock. So then this will give you the risk premium. This is risk premium, right? So now here market risk premium you can see that is 7%. Now you can determine the required rate of return using CAPM or the security market line. CAPM or security market line. So simply beta values are there. So you can apply that CAPM formula. So this is the formula. This is the formula. So you can apply. I will give the answers and later you can check. Market risk premium was 7%. For all the cases, market risk premium is 7%. Security A beta we have calculated 1.29. So 1.29 into 7% plus risk-free rate. Risk-free rate. This is our formula, no? Risk-free rate plus market risk premium into beta. So that is the required rate of return. So that is the theoretically rate of return should be based on this beta risk. Make a window rate of return. Now for the stock A should be 17% related to its systematic risk. Because unsystematic risk is now you can diversify it now. We don't need to worry about that. We are not worried about the unsystematic risk. So for the security B, 7%, 8%, beta was minus 0.86. So you can see required rate of return at 2%. C 14.5%. Market is, you can see that is 15%. Beta is 1. So always that is market return 15%. Here 8 because here beta is 0. So that is 8%. So those are the required rate of returns. Now earlier you have calculated expected return based on the probability distribution. You have calculated expected return of these securities. Now you can compare these expected returns with this required rate of return to identify whether this particular security is undervalued or overvalued or fairly priced. Now you can compare, this is the expected return, this is the required rate of return. Then we expected return කියලා කියන අපේ forecasted return එක අපේ forecasting ටික අරගෙන probability distribution එකට දාලා අපේ forecast analysis එකට අනුව ආපු return එක expected return. But this is the theoretically return should be on this particular stock related to the systematic risk. ඒ අදාළ relevant risk එකට අනුව මේක තමයි විය යුතු rate of return එක. That's the required rate of return. This is based on the security market line or the CAPM. Now you can use this two numbers, expected return and required rate of return, to identify whether the stocks are overvalued or undervalued. Now here you can see expected return is 17%, but the required rate of return is 17.4%, but the required rate of return is 17%. So now here expected return is greater than the required rate of return. So now this stock has undervalued. We have undervalued that because the rate of return should be 17%, but we have valued the security using the expected return 17.4. Right? All the correctly priced securities are plotted on the security market line. Either may stocks are correctly priced karanang. Again, there is no overvaluation. There is no undervaluation, fairly priced. If all securities are correctly priced, then all these securities should be on this security market line. On this line, may line එක මත ඒ stocks ටික ඔක්කොම එන්න ඕන if they are correctly priced. But the assets that lie above the line are undervalued. එතකොට මේ line එකට security market line එකට උඩින් තියෙන ඒවා ඒ කියන්නේ their expected return is greater than the required rate of return. So they are undervalued because you calculate value using this one, no? Cash flow divided by, this is our fundamental model, no? Cash flow divided by discount rate or our expected return using this one, no? You valued this one, no? May stock එක value කරලා තියෙන මේ expected return. So now this stocks has a undervalued. fairly value වෙලා නැහැ. මොකද return එක වෙන්න ඕන 17%. ඒතර 17% කියලා කියන්නේ it is similar to the discount rate. ඒතර 17%ෙන් තමයි security එක value කරන්න ඕන. නමුත් අපේ forecast එක අනුව 17.4 වලින් value කරලා. So therefore this stock has undervalue. This is in above the SML. This is in above the SML. Now if you look the next one, this is market now. This is okay, fairly priced. But see, expected return 13.8%, required rate of return 14.5%. So required rate of return is greater than the expected return. So now here, this is overvalue. This is overvalue because that rate of return should be 14.5%, but the expected return is 13.5. So the stock is below the security market line. වෙන්න ඕන මෙතන. නමුත් මේක තියෙන්නේ මෙතන. So that is below the security market line. So that it is overvalued. Treasury bills, no issue. They are fairly valued. Then what about the security B? Expected return 1.7. Required rate of return is 2%. So that is also overvalued because we api value කරලා තියෙන අඩු rate එකකින්. So therefore stocks in the overvalue. ඒතර මේක තමයි correct වෙන්න ඕන. ඒතර මේකට correct වෙනවා කියලා කියන්නේ so that stock එක මේ line එක මතට වැටෙනවා. So all the stocks should be on the security market line if stocks are fairly priced. So this is how we use the security market line to identify overvalued saha undervalued stocks, right? So we can use for the valuation, even for the security valuation, we can use CAPM to identify underpriced and overpriced stocks. The assets below the line are overvalued for a given amount of risk, they yield lower return. So I think that's what I explained, right? So now this is related to the individual stocks. Even beta you can apply for the portfolio. No need to be a efficient portfolio. This CAPM you can use to you can apply to a portfolio also for the individual stocks as well as for the portfolio. If you apply in portfolio, you can calculate portfolio beta. That is, portfolio beta is weighted average beta. Suppose that you are going to invest in 50% A, 50% B, these two securities, A and B. You are going to construct a portfolio, invest in 50% of your wealth A, 50% of your wealth B. So then your portfolio beta, you can calculate, that is weighted average. Portfolio beta is the weighted average. So you can see 0.5 into 1.29 plus 50% into minus 0.86. So then portfolio beta, your portfolio includes two stocks, A and B. Beta is 0.22. Now you can apply CAPM. You can apply CAPM. This is the CAPM formula. So beta is 0.2. Market risk premium, api isala calculate kara 7%. So you can see your portfolio required rate of return is 9.5. Your portfolio required rate of return using weighted average return. Then api isala portfolio ke return එක හෙව්වේ weighted average එකෙන්නේ. දැන් අපි මෙතනදී beta දාලා CAPM එක දාලත් මේ හෙව්වා. ඒතර අපි weighted average එක ගත්තා නම් මෙතන A වල return එකෙන් 150යි, B වල return එකෙන් 150යි. 50% on 17.4, 50% from 1.7. So that is also 9.5. Then බලන්න with the both this weighted average one as well as the SML, both are giving the same one. So therefore that portfolio is fairly priced. That portfolio is fairly priced according to its market risk or the beta risk. So likewise, you can apply the CAPM. Now, what is the CAPM? I think we discussed that CAPM. So CAPM is a empirical model. It's an equilibrium model that specify the relationship between risk and required rate of return for assets held in well-diversified portfolio. So you can calculate required rate of return of asset held in a well-diversified portfolio. It's based on the premise of that one factor. We call this CAPM as a one-factor model. It's based on the market risk or systematic risk or beta risk. That is one factor. So what is the factor? Market risk or the beta risk or systematic risk. So CAPM we have developed based on the market risk. So therefore we call this as a one-factor model. But if you look at the literature, there are so many multi-factor models have developed. Pharma French 3-factor model, 4-factor model, 5-factor model, arbitrage pricing model. So likewise, there are so many other factors. They are arguing that not the market risk only, but there are other factors that affected to the risk. So likewise, empirically, there are certain developments, certain empirical models. But anyway, this CAPM is based on only one factor. It says that market risk is the factor that we have to consider when we calculate in the required rate of return. So price the risk using market factor. Now, actually this CAPM is an empirical model. It has developed in a world where these assumptions are supposed. Market is efficient. So all the investors in the market, they are getting the every information equally. There is no any deficiencies in having informations. Investors are homogeneous. They expect, you and me both are expecting the same expected return because we have same information. No? So when we are analyzing, you and me both are same. So there is no any deficiency. There is no any implications, imperfections in the market. Risk aversion and mean variance optimization. අපි දෙගොල්ලම කරන්නේ risk aversion එකයි mean variance optimization. So therefore we all are same thinking. We are homogeneous. So likewise in such a world we have developed this CAPM. And also behavioral things are not impacted on the CAPM. Certain empirical developments are there. In future, when you are specializing in finance, you will learn behavioral finance, factor model, and other models, momentum models. So like certain things are there. This is only the one factor model. Unlimited lending and borrowing are possible. In this CAPM world, it assumes that you can borrow unlimitedly, no restriction at risk-free rate. And also you can invest unlimitedly on the risk-free assets. So this is certain assumption, homogeneous expectation or the complete agreement about the expected return and standard deviation. So this is some of the assumption, right? There are certain more. So you have to understand this CAPM is work. CAPM is effective in a world where such assumptions are there. But when you look at the market, there are imperfection, behavioral impacts are there, making a risk relationship security is undervalued. So likewise certain issues are there, but this is the super model developed so far to price the risk. Right. So then I will briefly explain what are these factor models. Actually, I think 2-3 slides are there. So as an alternative to the CAPM, to accommodate the risk that may not be captured by the market portfolio alone, is multi-factor model that incorporate factors that may be other sources of price risk, right? In this CAPM, this is only the market portfolio and the market risk, but this multi-factor model incorporates factors that may be other sources of price risk, like risk for which investors demand compensation for bearing. It can market portfolio එක market risk එක විතරක් නෙමෙයි investors ලා කියනවා මෙන්න මේ variable එක වෙනස් වෙනකොට risk එකක් තියෙනවා. ඒතර ඒකටත් compensation එකක් තියෙනවා. So likewise they are claiming other factors with the multi-factor model, right? Risk for which investors demand compensation for bearing. So including macroeconomic factors, some empirical models are developed. They claim on company specific factors also. But in the CAPM, we say that company-specific risk is totally diversified away, but there is some synchronized and unsynchronized risk. So in these models, these factor models, they are arguing some firm-specific factors also to consider in pricing the risk. So likewise, certain factor models are there. One is arbitrage pricing theory or arbitrage model. In this arbitrage model, you can include many factors. There is no limits. Based on your analysis, certain factors you can include, and empirically you can see whether the error variable is significant or not. So likewise, අපි regression එක කරන්නේ factors දාලා බලනවා stock return එක totally explain කරනවද නැද්ද කියලා. ඒතකොට certain factors you can include it in the arbitrage pricing model. But this CAPM is a single factor model. Arbitrage pricing theory assumes that market risk can be caused by economic factors such as gross domestic product, inflation, structure of the interest rate. These factors could affect to the price or the risk differently. So therefore, under the arbitrage pricing theory, sensitivity of the assets return to each factor is estimated. Apart from that, this is the model of the arbitrage. So you can expand arbitrage pricing theory or the model, whatever the number of factors you have. So each factor is, then now if you take this one, RJ, it is the required rate of return on a portfolio sensitive only to the economic factor F. So this may be the inflation or GDP or the interest rate. So one of the factor. So then required rate of return on a portfolio sensitive only to the economic factor J. So then the slope measure the sensitivity of stock I for the different economic factors. So this is empirical model. Apart from that, there are some other models. Actually, the limitation of the arbitrage pricing model, when this model is developed or this theory is developed, it does not specify what are the factors should include. What are the factors influence on stock returns? Yes, but in the CAPM, our argument is that market risk or the systematic risk captured all other variables. දැන් අපි මෙතන one factor model එකක් විදිහට CAPM ගන්නකොට අපේ argument එක තමයි මේ අපි ගන්න beta factor එකෙන් අර ඔක්කොම risk එකට බලපාන සියල්ල price වෙලා තමයි මේ required rate of return එක එන්නේ කියලා. නමුත් CAPM එක empirically test කරනකොට අපි දැක්කා error එකක් තියෙනවා. error term එක significant. එතකොට ඒ කියන්නේ මේ required rate of return එක explain කරන එකම factor එක market risk නෙමෙයි. There are some more other factors. ඒතර ඒ empirically ආපු failure එකත් එක්ක තමයි මේ multi factors එන්නේ. multi factors develop වෙන්නේ. ඒතර CAPM එක not perfect. ඒතර CAPM එකෙන් perfectly risk එක price කරන්නේ නැහැ. Because that error term is there. Error term significant. So that means there are other factors no. අපි regression එක run කරලා error term එක අපි බලනවානේ error term එක ලොකු value එකක් එනවා කියලා කියන්නේ තව factors මේකට දාන්න පුළුවන් කියන එක. So therefore on that way factor models will come. ඒතර arbitrage pricing theory එකෙන් ආර්ගියු කරන්නේ මේ වගේ factors දාලා අපි error term එක අයින් වෙනකන් අපි බලනවා මොනවද තියෙන factors කියලා. ඉතින් මේවා empirical world. මේවා not the theories. ඒතර ඊට අමතරව ඔයාලා දන්නවා මේ Palmer French develop කරලා තියෙන different factors, 3 factor model, 4 factor model, 5 factor model. Even today you can see 5 factor model. So this 3 factor model, they include, apart from the market excess return or the excess market return, this excess market return is equal to the beta or the market risk, right? Equal to the market risk. So apart from this one, they include SMB factor. SMB means size factor. Small minus big. Size කියලා කියන්නේ market capitalization එක. ඒතර ඒක risk factor එකක් විදිහට මේ Palmer French के 3 factor model එකේ ගේනවා. 92 93 papers වල 92 93 මේක ලොකු කලබගිනියක් කරපු empirical finding එකක්. ඊට පස්සේ එනවා 4 factor model momentum එකත් එක්ක. 5 factor 4 factor ඔය විදිහට මේ empirical world එකේ දැන් ඔයාලට උනත් ඔයාලගේ research එකේදී factor model එකක් identify කරගන්න පුළුවන් මේ price risk එක price කරන්න. So that way. So SMB factor is the size factor. HML factor is the book to market ratio. Book to market factor. High to low. HML mean high to low. High minus low. SMB mean S minus big. ඒතර ඒ difference එකට තමයි මේ factor model එක මේ තියෙන්නේ. This is risk-free rate. This is excess market return. This is small minus big or the size factor. This is H minus big. That is we call book to market value factor. Value factor, size factor, and the market. So likewise, this is the 3 factor model. So with the data, you can apply this one also. You can test. This is sensitivity of the stock I to the market return, beta I. CI means, or the CI means, yes, sensitivity of the stocks to the size factor. DI means, this is I, right? Sensitivity of the stock I to the value factor or the book to market factor. So likewise, this is what the empirical world. Actually, I think from that point I'm stopping, no need to go to further and further. But anyway, you could see the end. So this is not the end. So there are certain developments in the empirical world related to this price in risk. Now here there is some applications, say inputs. Beta is 0.9. මේ beta කියලා කියන්නේ අපි අර කතා කරපු beta එකමයි. Risk free rate එක 6.8යි. Market risk premium is 6.3. ඒතර market risk premium කියලා කියන්නේ market excess return. That is expected return market minus risk free rate 6.3%. And CI 0.5. Right? You are given the variables. That is actually the coefficient of the size factor. So expected value for the size factor is 4%. DI is 0.3. This is the coefficient of the value factor. So expected value of the book to market is 15%. So then if you know these numbers, if you have calculated these numbers empirically using the empirical data, then you can apply this model to estimate the required rate of return. So like this, you can see. Now, if the same example, you estimate the required rate of return using CAPM, so you see the number. In the CAPM, only the market risk, no? So market risk was 6.3. So with the CAPM, say 12.47 required rate of return. But with the three-factor model, it was 8.97. So these are three models. This is one-factor model. This is three-factor model. Right. So I think I am stopping that point, right? So far we discussed, if you recap the things what we discussed, the journey that we came here. So initially we started with individual stocks returns and the risk. Then we came to the portfolio. With the portfolio discussion, you realize that what is diversification. So with that, you realize relevant risk is not the total risk. Relevant risk is the market risk or the systematic risk. The market risk එක measure කරන්න අපි models අපි දෙකක් කතා කරා, capital market line එක on the for the efficient portfolios, but for the non-efficient portfolios and also for the individual stocks in the market, you can apply the CAPM empirical model that we discussed to estimate the required rate of return. So finally, we discuss that is not the end. With the one-factor model, we are moving to the multi-factor model. In your portfolio management course in future, you will discuss these things very deeply. Multi-factor model, under the capital assets pricing models. Right. So those are the things actually we discussed. Now I will stop that point. This is risk and return. So I am going to start the cost of capital. So if you have any clarifications in regarding this, you can ask. Actually, because of this interruption in the power and the things, I will allocate some common time convenient for the both groups, weekend and the weekdays. Finally, before the exam, if you have any questions, any clarifications to discuss, I will arrange a Zoom meeting by discussing with the MB unit later, right? Because I think you have many disturbance and troubles to join sometimes because of that. Do you have any questions or any clarifications? Right. If you don't have any questions, any clarifications, I can go to the cost of capital. That's our next topic.
Madam, in the exam, what you expected, it is related to some calculation? No?
Actually, at least you should be able to calculate portfolio expected return and risk, and also to apply the CAPM model. Because if you are given the data, you should be able to apply the CAPM model and to estimate the required rate of return. And also you should be able to identify that whether particular stock is overvalued or undervalued. That very simple calculation. No? Up to the portfolio risk return calculation, you should have to know thoroughly. Are you okay? Do you have, if you have any questions, any clarifications, you can ask, no issue.
Madam, what we can do, we will go through the recordings and all. We will come back to you again if there are any difficulties.
Yeah, definitely, for sure. I will allocate some time before the exam, after my lessons, and also after your semester is end. I will allocate some 1 hour, sometime in night, maybe around 9 to 10 or something. So you can discuss if anything is related to my discussion, we can discuss. So I will let that time at the end of the semester.
Thank you, madam.
Okay. So now I think I will try to discuss few things related to the cost of capital without taking much time, right? That is our next topic. Right. So this is not much difficult, like the risk and return. So you can understand things very easily. Actually, nothing we are going to do here, just simply the calculation cost of capital. When it's come to the cost of capital, in your first lecture, I am confident that you have learned there are 3 main decisions that financial manager of a company should take: investment decision, financing decision, liquidity or the working capital management decisions, basically. So when he taking this investment and financing decision, without knowing this number, without the cost of capital of the company, he or she can't take that job. He can't do that job perfectly. So therefore, this is very important number. In time value of money, you could remember that you calculated the present value of future cash flow, discounting them using a discount factor. So what is this discount factor? It is the cost of capital of the company. In our next topic, that is capital budgeting. So we are evaluating long-term investment projects. So when you evaluate long-term investment project, you have to calculate net present value, IRR, profitability index. So you should know the discount factor in order to calculate the net present value, NPV. So what is the discount factor? Cost of capital. So this cost of capital reflect the risk of the company, and it is the minimum required rate of return of the investors of the company. So likewise, this is very simple calculations. If I say simply, this is our capital structure. This is say our company's capital structure, right? This is say 60% of the asset this company has financed with the equity capital. Say 30% of the asset by the debt capital. Say another 10% by the preference shares. So this is the capital structure of the company. This is the way how this particular company finance their asset. This is their capital structure. For each capital, you should know the cost. What is the cost of equity? Just assume 12%. What is the cost of debt? Say 9%. What is the cost of preference shares? Say 6%. So you should know that number. Once you know each component cost of capital and also the weight on each component, so then you can calculate overall cost of capital, weighted average cost of capital. So weighted average cost of capital mean weight of the preference share multiplied by its cost plus weight of the equity multiplied by its cost, weight of debt capital multiplied by its cost. So that is the weighted average cost of capital. This is what we are going to calculate. This is what we are going to do with this lesson. Very simple. So once you know this number, this is our weighted average cost of capital or the cost of capital or the marginal cost of capital. This should be the marginal cost of capital because that is for the future investment. This number should be the marginal cost of capital. That is the cost of capital to raise 1 rupee of capital, new rupee of capital. මොකද අපි හැම වෙලේම budget investment එකක් කරනවා කියන්නේ අනාගතයටනේ. So we are evaluating future. So that should be, therefore this WACC or the cost of capital should reflect the marginal cost of capital. Right. So this is what we are going to discuss. I think at the end you will realize the things. So basically learning objectives, you will understand what is and how what are the sources of capital. And also you will learn how to calculate component cost of capital, cost of debt, cost of equity, cost of preference shares, and finally overall cost of capital. So those are the things that we have to discuss. Right. So now I think this diagram you might have seen this at your first lecture. So here this is the role of finance manager, is responsible this job. So if you look at this one, this first job or first role, it is raising capital. Raising capital. Raising from where? From the market. There are investors like you and me. So we are looking to invest in companies, preference shares, equities, bonds, and so likewise we are waiting to invest. We have excess funds. So finance manager's first duty is raising capital from the market using different sources. When they raise the capital for the investors in the market, they have their required rate of return. Then api giya පාඩමේ දැන් කතා කරන්නේ දැන් මම ඉන්වෙස්ටර් කෙනෙක් නම් මට තියෙනවා මගේ අවශ්‍යතාවය මගේ required rate of return එකක් තියෙනවා. ඒතර මගේ required rate of return එක කියන්නේ මොකක්ද කියලා දැන් දන්නවා. එතකොට if I am going to invest in the say ordinary shares of this company, if I am going to invest the ordinary shares of that company, I have my required rate of return 18%. So I have to estimate my required rate of return by looking at the market portfolio and the prevailing risk. So everything considering, I have to estimate that. So then finance manager, when raising the capital from this particular investor, so finance manager should responsible to earn this 18% rate of return from the investment. This finance manager, after raising the capital, he can't keep this money in the lockers, no. He have to invest them. He have to invest them in the company or the different projects. Our next topic is identifying the feasible project using NPV, IRR, payback. So likewise, we are using very simple techniques. So this finance manager is responsible to earn a rate of return or internal rate of return greater than this 18%. Otherwise, that objective of financial management is shareholders wealth maximization or value maximization or value maximizing market price of the company. So we can't achieve these objectives without earning a rate of return greater than 18% from this investment. Why? From the whatever the things you invested, you have to pay 18% for this investor. In terms of dividends or in terms of capital gains or whatever, you have to pay. So once if you earn less than say 18%, if you earn 15%, at least you can't satisfy the investor. So what happens? So long term you will fail. Your attractiveness is going down. So in the marketplace, demand for the shares is going down. When the demand of the shares is going down, market price drop, then market value is dropped, then your company will bankrupt and another company will acquire your company. So that's where you will collapse. So now in our focus, how to estimate cost of capital here. This is the investor's required rate of return. This is the investor's required rate of return. So when we are raising capital from the market, is this required rate of return can we consider as our company cost of capital? So that is we have to discuss. Right? This is our focus. Right. So what are the sources of capital? So, right, before going to that, what is cost of capital? What is cost of capital? The cost of capital is the rate of return that suppliers of capital, lenders, owners require as a compensation for their contribution. That is the cost of capital. The cost of this capital is an important ingredient in both investment decision making, by the company's management and also the valuation of the companies by investor. This cost of capital is important for the company as well as for the investors also. දැන් අපි හිතමුකෝ දැන් මම කම්පැනි එකක ඉන්වෙස්ට් කරන්න යනවා. ඒතර මගේ රික්වයර් රේට් ඔෆ් රිටර්න් එකක් තියෙනවා. මම ඒතර බලනවා කම්පැනි එකේ cost of capital එක කීයද. ඒතර කම්පැනි එකේ cost of capital එක කියලා කියන්නේ ඒ කම්පැනි එක earn කරන්න ඕන minimum rate of return එක investors ලා satisfy කරන්න. එතකොට ඒ rate of return එකෙන් මම security එක value කරලා බලනවා දැන් market එකේ මේ share එක under value වෙලාද over value වෙලාද තියෙන්නේ. If it is over value, I am not investing. If it is under value, I may invest it. So likewise, this cost of capital is an important ingredient, both investment decision making by the company, as well as from the valuation point of view by the investor. Now, I think Professor Champa might have teach you that you have done the bond valuation, security valuation, ordinary shares valuation, preference shares valuation. So when you value these shares, you discounted expected cash flow using the required rate of return. Do you remember that? When you doing the bond valuation, security valuation, you discounted the expected cash flow to calculate the intrinsic value using required rate of return. So what is this required rate of return? It's a company cost of capital. So company cost of capital from the investor's perspective is required rate of return. ඒතොර actually දැන් මේ cost of capital එක අර අටපට්ටමක් දිහා අටපැත්තකින් කීප පැත්තකින් බැලුවත් අපි දකින්නේ එකම අටපට්ටම වාගේ. දැන් මේක company එකේ cost of capital එක, company එකේ earn කරන්න ඕන minimum rate of return එක, time value එකේදී ඔයාලා පාවිච්චි කරපු discount rate එක, investor කෙනෙක් security value කරනකොට එයා use කරන discount rate එක, එයාගේ required rate of return එක. If the market is efficient, if the market is perfectly efficient, this required rate of return, cost of capital, whatever the investors required rate of return should equal. Then market is efficient. If the market efficient නැති හින්දා තමයි මේ undervaluation overvaluation තියෙන්නේ. ඒතර අපි company එකේ share එක value කරනකොට investor කෙනෙක් විදිහට මම දකිනවා මේ stock එක මගේ required rate of return එකට වඩා එක බලනකොට this is in overvalue. So therefore I am not going to invest. If it is undervalue, yes, okay, I will invest because I believe that market will correct in little time. So then I try to get the capital gain. So when it is undervalued, I am trying to invest. So that way, there is another story. So this cost of capital is an important ingredient from both right. I think some connection issue might be. Anyway, try. Right. So then what I was explaining, this cost of capital has synonyms. We consider it as a discount rate. We consider it as the required rate of return of the project. It is the cost of capital. From the investor's point of view, it is the required rate of return. So likewise, different names are there for the cost of capital, but it implies same number. It implies same number, right? So what are the sources of long-term capital do firms use? I think this is not new. So long-term capital mean this is the capital that you finance for the long period. So whatever the impact of this capital, you will get for more than 1 year. That's what we call the long-term capital. No, you can for a long period, maybe ordinary shares, bonds, debentures, preference shares, bank loans. So they are expecting to repay within more than 1 year. So therefore, we are trying to get some returns for the long period by using the long-term capital. So what are the sources of long-term capital? Long-term debt, preferred stock, common stock. So when it's come to the common stock, there is a two versions. Is my connection is okay now? Some of you have told me that my sound is not good. How about now?
Okay, madam.
Okay, so common stock. This is ordinary share. There is two versions: internal equity and external equity. This retained earnings belongs to whom? Retained earnings means from the profit, you are retaining something for the reinvestment purpose. If that was not retained, so you would have to pay as a dividend. So this retained earnings belongs to common shareholders, for the owners. Retained earnings is not a claim of the debt holders, bond holders, bankers. So this is, therefore, we consider as an internal equity. Internal equity. So new common stock, that is when we do a new stock issue, that is we call external equity. That is external equity. So therefore, we have to identify cost of internal equity, cost of external equity. So those are the sources of capital. Now, if you rank them based on their risk, if you rank them different sources of capital based on this risk and their required rate of return, so this is the line. This is the line. So this is short-term government debt. You can see there is lowest risk somewhere here because it has only default risk. This is government bonds. Then corporate debt. Corporate debt means bonds, debentures, bank loans, everything. Right? So the risk of the preference shareholders is more than the corporate debt holders. So therefore, they are in somewhere debt holders and equity holders. So in a case of bankrupt, these bond holders and debenture holders have first priority to claim their coupon, interest, their principal before the preferred stockholders, before the preference shareholders, because in this rank they are above the debt holders. So therefore, you can see their required rate of return for the preference shareholders. Required rate of return is higher than the debt holders. Because of what? Because of the risk. Because that now, if you look at the common shareholders, they are the residual owners. They are the residual owners. They bear the ultimate risk of bankruptcy. So they have to wait until all the obligations are paid off. If something remains, if something balance, then they can get, otherwise they have to bear the risk. So therefore, they are the one who exposed to the high risk. So therefore, their required rate of return is very high compared to the debt holders. But in case of the say, good thing happen, if the profit is increased and the company become attractive, share prices increases, dividends are increases. So if the prosperity or the positive things are happen, then common shareholders have priority to claim the more dividends, because they are residual owners. Residual owners can api singalan කියන අවශේෂ අයිතිකරුවෝ කියලා. So in case it is explaining using that mother of the family. So once that rice is cooked, after dividing to all the other parties, that she will get the part. So likewise, we call that as a residual owners. So they have to wait. This is actually at the bankruptcy. They can't ask something at first. They have to bear that risk. So likewise, you can rank these different sources based on their risk. So I think you can see එතකොට දැන් අපි required rate of return එක හොයනකොට debt holders ලගේ required rate of return එකට වඩා preference shareholders ලගේ required rate of return එක වැඩි, ඊටත් වඩා equity holders ලගේ required rate of return එක වැඩි. Why? What is the reason? Because of risk. Because of risk. Right. So now we can look at the this overall cost of capital number. So this is what is the formula that we can use to calculate overall cost of capital. I feel like to stop at this point. What do you feel? I think we can start the next day this thing, so we can continue. Shall we stop? I think that's sufficient for today.
Okay, madam.
Okay, madam.
Are you happy about that?
Yes, another.
So I think that's around 3 hours period. So